Okay, I'm sharing handouts on our WhatsApp group. Please, you can access if you want to, and we will go through and refer some questions. Today lesson will start in 2-3 minutes. If you have any question, please feel free and ask it. Hello, welcome. Thanks for joining. Okay. 2 more minutes, we'll start. Okay, welcome everyone. We'll start. So last week we learned about our LO1 learning outcome 1, and we discussed about various accounting standard. We discussed about IAS 1, International Accounting Standard 1, about the financial statement need to be fair and the information should be true and fair. So that's we learned during last lesson. We discussed about IAS 2, which is about the inventories, and we said inventory normally 3 types: finished goods, raw material, and work in progress. And we had a discussion about inventory should be recorded at cost or net realizable value, whichever is the lower. Then please we discuss about IAS 10, which is about financial yes, events and post event reasonable adjustment. So we learn about, let's we'll do a bit recap what we learned during last lesson, and then we'll start our lesson. Okay, so please with recap, last week we discussed about different accounting standard: IAS 1, IAS 2 about inventory, IAS 7 about cash flow, inflow, outflow, then cash flow statement, and we discussed IAS 10, which is post events. Within 90 days we need to be financial statement. If not been signed, then within that's adjusting. So we discussed about IAS 16, which is about property, plant, equipment, and IAS 18, revenue, about how we can treat other income in the book of accounts, and we discuss about IAS 36, impairment, IAS 37, IAS 38, about goodwill adjustment and all. These, the standard we discussed previous lessons, and we discuss about, how many types of financial statement and qualitative financial statement characteristics we discussed during last lesson. Okay, so please, this week we're looking LO2, which is understand the appropriateness of financial reporting framework, which we'll discuss. Please, always good to be reflect your current knowledge about financial statements and adjustment, and always look around the double entries, please. That's the key element. and of course accounting standard. And today lesson will be sole trader, partnership, grant accounts, and within that, we'll go through consolidated statement for public limited company or private, and with our discussion cover overall the content. Okay, so when we say the company normally has the limited liability, but the in sole trader can be unlimited liability, and the company need to be follow the Company Act 2006 in the UK, and the company accounts, of course, we need to be submitted to the company house and HMRC as well. Okay, so please then, of course, the calculation, taxes and all, which you are well aware of, because of course most of we working in same field. Okay, so please, thus we need to be keep in mind. Other question, of course, the layout of the financial statement can be slightly different. We need to be thinking. Hello. So please, we need. Okay, so we need to make sure financial statements should be recorded in the book of account under IS1 if your business is throughout under different accounting standard, different gaps, maybe gaps one and all, general acceptable accounting principle, and we need to be look around accounting for the limited company if you're using please standard, so we can look around different layout in a minute. And that's sole trade and partnership revenue is especially in international accounting standard, cost of sales, and then of course we're not including, and we are few heading admin expense, distribution expense and all. So please you look the layout under IFRS International Financial Reporting Standard. The form normally we use revenue, 2 years the statement, of course comparative figures, cost of sales, yeah, and gross profit, distribution cost, of course your company policy, which expense you can, because we are reducing the heading making, and then of course we are giving the notes. Profit from operation, it can be before tax, after tax, of course taxation, then of course profit after tax. So please we need to be look around the pro forma of financial position, which is historical figures, please. Intangible asset first, property, plant, equipment, then please we can look around tangible asset, of course, come any other asset which is a physical substance, current asset, then of course all the current assets like inventory, trade receivable, cash in hand, prepaid. So please these, and then total asset, of course we can minus the liability, we can say net asset, and then so different layout please we can, but we when we following the standard we need to be make sure we follow the layout according to the standard. Okay, share capital, share premium, return earning, non-current liabilities, then current liabilities, and of course net asset should be equal to equity figures. That's the way we can, as the accounting equation. Huh? So please we discuss about one qualitative characteristics, conceptual framework in the previous lesson as well. Fundamental qualitative characteristics, is it relevant, is it capable, make different decisions, including all the material information. Faithful representation, information should be free from error, neutral, and faithful, and the complete information give to the user. Okay, so in hand qualitative comparative figures, 2 years, verifiability, when we saying asset owned by, we can verify it. Is it timely line within 90 days? Is the figures those have the basic accounting knowledge about, and they can understand things maybe. So that's which we need to be look around the note to the financial statement. These are also very important, of course accounting policies, different policies about adopted by the director, as are special policies for information need to be true and fair of the companies are not allowed to change establish accounting policy, because like if you're using like inventory, you're valuing on the first in first out method. If you want to change into last in first out method evaluation, then of course you have to make sure you reinstate the figures of the previous years, because you have otherwise you're not giving the true and fair information, comparative figures. Okay, depreciation, please. Depreciation method, always we need to be make sure either you did using the reducing balance method, sum of digit method, or whichever method, and that's stick with it. And if you want to change anything, depreciation method, you need to reinstate. For disposal of assets, their values or revaluation figures, those we need to be, because financial statement need to be true and fair. Okay, please, irrecoverable debt, which is also known as a bad debt, which we can't. So those figures and adjustment need to be accordingly in the trade receivable, or we call debtors account, or we call sale ledger control, because these are the three terms we'll carry on: debtors, trade receivable, or we call sale ledger control account. These are exactly the same thing. It means you're selling things on credit and you're supposed to be receive the money from your customer. And then of course we have a bad. So please, when you deal with things, remember two words, please: debt and click. The what is mean. D represent debit, E is expense, A is asset, D is a drive. When these increase things, like your expenses increase, you have gas, electric bill, you have the salary, you have advertising. These are expenses, and expenses should be treated in in the book of accounts, in the profit and loss. Then we can say is increased, so we should do debit. I mean, we do the double entry bookkeeping. And please, of course, if you're not paid the expenses, then you can create the liability, and the liability is a credit when these increase, and income is a credit when these increase, capital is credit when these increase. So please, when these decrease, opposite credit is a debit and debit is a credit. So please, that's we need to be keep in mind, when you do the double entry bookkeeping, because that's which you need to be follow the rules of double entry and adjustment in the book of account. Okay, so please, accrual and prepayment element, that's huge, carry on, because we need to be as accounting, of course, nowadays software and the dates, and the nominal code, that's quite crucial to be how these paid up, that's we need to be look around. Account accrual of expenses, please. When is the expense? It mean expense incurred not being paid. When we say accrual expense, mean expense incurred like gas, electricity you use, so you not paid it your bill yet, maybe bill not arrived yet, but still you need to be do expenses debit, and the credit your liability based on, maybe you can do estimation even. Okay, prepaid is mean advance paid, like car insurance, you paid 12 months, but your year end on the 31st December, the remaining months will be prepaid as an asset, and the other, because you need to be look around because true and fair and accrual basis, all the income and expenses of the year should be treated in the year. If related to the different time period, it should be make adjustments. So we need to be make sure, please, that we need to be look around, and we need to make adjustment. But when we do the accrual and prepayment of income, accrual income mean income and but not received yet. So we have to do the income credit and debtors, which is debit, because of course your asset will go up and your income will go up. We said debt click. So please, that's also quite crucial. Prepaid is mean advance paid things. So prepaid income is if you receive the income in advance. So first place, when you receive the cash, you write it cash debit, and the income credit as a sale, but that wasn't in the because that was the prepaid advance paid, like you in a construction contract, because you not completed any work, you can't recognize as the revenue under IS 17 18. Really, we need to be look around in the light of the accounting standard as well, and we need to be make sure we'll make the adjustment because the financial statement. So what we'll do, we'll decrease our income, so we do in debit, because normally when income go up, will sales go up, our income will do credit, but now we need to reduce it, we'll do debit, because first place we put it as a credit. Then of course increase your liabilities, because you not paid it yet and it's not yet your income. So that's liability will go up, because you're holding the money of someone because you're not provided the services. Please, any adjustment you do, always good to be draw the timeline when your year start and when the year finish, because 12 months, and then you need to be make sure adjustment true and fair information in the financial statement. Like as we discussed, we can summarize like accrued expense, the liabilities, the expense will increase and the accrued the liability will increase. When the income accrued, the accrued income we do debit, and the income will be credit. It means unearned income because you didn't receive it. When we look, on expense incurred not being paid, and income will be opposite of expense. So please, we need to be prepaid. Prepaid mean advance paid. So prepaid expense is asset. So the expense will be credit because first place you put it, and there wasn't expense like when you paid the insurance, but the insurance was for a whole year. If you pay yearly premium, so that's we need to be look around, and we need to be make sure we'll make adjustment in the book of account accordingly. Yes, you can say you're right. Yes, if we can. Yes, it's unearned income and deferred, because not now, it can be in future. Okay, so please, prepaid is the advance paid, and then of course, like we said earlier, those we need to make adjustment in the book of accounts. So please, the timeline is very important. Okay, different types of errors, please. Of course, principal errors is the huge, like maybe we're treating the creative accountant playing the key role here, like maybe a couple of you heard about Enron and various other companies, the playing the things, in the book of account. But as a whatever we can do in our capacity as an accountant, of course, we'll try our best to be true and fair information too, because if they have internal accounting department, we just submitting their return. Of course, we can't. We can only most of we can rely on their information, whatever they provide us. We're not investigator. We can look around in the light of basic rules. Those are correct and true and fair information, and we can advise to clients. Of course, commission are missing things, error of maybe we charging to the wrong person, the wrong heading. And these, we need to be make adjustments, please. Different types of errors we can look around and we'll make adjustments. Yes, some errors like maybe in the trial balance you can't really find them, but still is error. Like if you done the expense debit instead of asset debit, you're saying is expense, and we look around the capital and revenue. So revenue expense, of course, day in and out expense are the low value expense, and then of course look around the taxation purposes. Well, the capital allowance you can claim on the capital expenditures, but not on the revenue expenditure. Revenue expenditures goes in the profit and loss, and the capital expenditures it goes in the balance sheet. So you have to be make sure adjustment accordingly. And of course, when you do the taxation side, you need to be make sure we can do accordingly. As we discuss about, some errors it can't be deducted, especially the principle of errors, because the principle is wrong, but your balance is balanced. That's fine. But it's not. You can't say, it's your expense when you're buying an asset, and asset is your capital expenditure, not revenue expenditure. So we have to think about it. So, okay, suspense account. Normally, you heard about this a temporary account. The previous quarter, one side was right, and the other side was because the suspense account won't goes in the final account. This will be really reconciled within the trial balance when you're preparing, and that's we normally doing in accounting practices. The framework of the preparing presentation about the financial statement. Please, set out, the concept of under the financial statement for external user. Please, we need to be look around international accounting standard board. We have, the setting the standard via international financial reporting, their role and the scope of, the framework deal with the object of the financial statement, qualitative characteristic, which we discussed earlier, comparability, understandability. Yes, timely the financial statements should be prepared, and of course, end of the day, all the material information, because otherwise it can be influence on the decision making, and we need to be make sure we will get the true and fair information in terms of. So please, we need to be recognition criteria. We have to look around the asset, anything which has the which will flow the future economics benefit, and we can measure reliably any expensive internally generated assets. So you have to make sure please use your the definition about asset, definition about liability. Liability is a legal obligation which arises from the past event. So please, that's you can treat them accordingly, and that's need to be look around in their values, revalues, faithful representation. We said complete, neutral, free from error. That's under IS1, general acceptable accounting principle. Those we need to be look around whichever you follow. So please, true and fair is under IS1. Objective of the financial statement. Of course, that it help and use it to make the financial decision. Various stakeholders they make the various decision. Of course, in their economic decision. So we need to be the user of the financial statement. Of course, is the equity investors. Of course, shareholders. We can look around. Then, of course, implies stock market analysts, business. The contact including customers, suppliers, competitors. Of course, we can look around. The government is really want taxes need to be paid. Okay. Please, we included the question in to meet the merit criteria, and we'll go through the ratio analysis. It's a separate handout, please. We have here two companies. One is called Anika and one Papika. We added some examples. So it's a separate formula sheets available on Moodle page. I included the formulas in next slide as well, which we'll go through in the following lesson as well. We can go through the gross profit divided by revenue, or we call sale. So we had the gross profit margin ratio, we can say 45%, 52. According to this, is Papika is a better than Anika. When we look, the profit from operations, we have Anika's only 9% and Papika is 11%. So according to this, Papika's performance is the better. But the problem in the sale is not mean you getting the cash. That's why we need to be look around the cash flow statement as well. We need to be look around other ratios to make final decision. When we look the gearing, the Anika has the 13% risk, debt to equity ratio, but Papika is 71%, and alternately, if we just compare with, because there are two formulas in a list view, so we have to think about 245%. So need Papika is a more risky, and if we look, because normally economics theory at the in financial high risk, high return, but you have to think about how much risk difference and how much return is only 2% different, but the risk is very high difference. So please, for the sake of 2%, you're taking 245%, 230% extra risk. That's not good. So that's we need to be look around interest cover, because it's 11.6 times they have a higher profit. Again, the interest amount is supposed to be paid, and but in Papika is only 3.1% if they have the profit is higher than the interest. So Papika is more risky than Anika. When we look the asset test ratios or quick ratios, or we can say current ratios, please 1.22 and then 0.6. So it means every 1 pound of asset, uh, they have 1 pound. Every 1 pound of liability, they have 1 pound 22 pound worth of asset. So, but Papika is only 65 pence of asset against 1 pound worth of liability. So in that case, so we can look around these ratios, which we'll go through. That we can compare the current and the past performance of the company into, and we can pick as an example, which I'll give you when we'll do the assignment. Horizontal analysis, try to be overcome the problem of vertical analysis. We can do the common, because when you're comparing small company with the big, so always try your best, the same industry, same size of the company, then you can your comparative figures will be right, so because otherwise maybe the financial ratios, industry averages we can look around, please. That's help, so what is the benchmark in industry? So if you compare the company's performance, uh, and because otherwise maybe it's not a good criteria, you comparing the small company with the big company with the multinational company. So we need to be look around in the light of these, because otherwise this is a problem. So consider the business strategy, please. Strategy is action plan. Then of course you can make the strategy, how to your maybe credit management policies. So your receivable days, your payable days, your third party reference, and how you give, and the various other decisions like DFSO for buy now pay in 5 years. But you have to think about, the after 5 years economic risk, the bad debts may be higher, the people default. So you have to think about and then look at the check, this, what your strategy. So in the case of this, please, we investors potential investors, lenders, suppliers, customer, they have the different, the expectations. They look around in the financial statement. Customer want good customer service, the company not dissolve. They want, if you're giving warranty and guarantees, that should be. And if the lenders want, their money will be back and secure, that's we need to be look around in. That's, financial ratios look around. So please, in both cases, Anikas and Papikas, overall, we recommend Anika is a better performance company compared to Papika. But because the Papika is a high risk company, so we draw the conclusion based on the ratios and the analysis, and then we can recommend to the client and they can make the decision themselves as well. Okay, so please to look around some question. I shared with you the handout, which is called Osborne handouts, please. 6.3 to 6.4 is relevant question, and those we can do. Please, I send you the answer sheet as well. Please, I copy the link for the further reading, and I shared with you F7 book as well on WhatsApp group. So please, you can download F7, which is financial reporting, and you have the Kaplan, and we have Osborne. These are two publishers, please. So we can look around. You have both question and answers. If you want to look around the layout of the financial statement, you want to pick the question. Then when we'll do the assignment discussion last lesson, please, we'll go through further. And of course, the consolidated statement, we can pick any question from as example, and underneath we can explain why, in this case, in some adjustments, which we'll go through those as well. Any question from anyone? Okay, so please, this week we went through our LO2. Please, you have the books available on our Moodle page as well. I shared with you. Please, if you want to, or if you want to be look around F7 ACC exam, and I'm not sure you set up account on Open Tuition, which is it's a free, and you can download the book from there as well, because this is your not exam based course, and it's just assignment based course, and we'll focus, where we can get the example. And please, there is ACCA article, those are quite good. Please, if you want to pick, on any particular topic, say ACCA article on IS1 passport or conceptual framework, so please, which we can look around, and that's, is quite good to go through. Okay, if you want to enhance the understanding, because sometimes it's interpretation. Of course, when you're using the software, a lot of things itself, but still, for interpretation, of course, the planning purposes or advice purposes to clients, we can look around these standards, please. Okay, so that's all from my end. Anyone, any question? If you like to ask, please, you can, and otherwise we'll keep up to here. And the next week we'll go through our LO3. I'll carry on, please, sending you. And if you want to attend IFA Direct next, you can Google it as well, please, and I'll send you the link, IFA Direct. And if you want CPD sessions on accounting standards or financial reporting in various standards, please, those are quite good, because especially nowadays, because companies have the operations throughout the world or in many countries, so they're following more international accounting standards and reporting standards. So please, that's where you can look around. And if you want to attend these network events, absolutely free, because you're a member as a student. Okay, so that's all from my end. Anyone, any question, please, if you want to ask? Okay, if no question, that's fine. We'll keep up to here. So please go through the WhatsApp group, and on the WhatsApp group, please follow the books which I send you. And the next week, we'll go through hello. So please, I shared with you here. You can see, and I hope you all on the WhatsApp group. If not, please let us know so we can include you on the WhatsApp group. So please, this is integrated book, and then of course the tutor copy is your answers for, please. and the chapter activities, please, and then answers for those. And further, I'll give you some self-prepared handouts, which for the activities, and we'll do the assignment and we'll go through those as well. Okay, so that's all. Thank you. Thanks for joining and have a lovely weekend. Stay safe, and I will speak to you next week then.
Thank you.
Thank you.
Thank you.
Thank you. Thank you.